US CPI unexpectedly accelerated in December today. Although core inflation fell from 4% to 3.9%. But headline inflation rose to 3.4% from 3.1%. Swap markets showed. After the release of the US CPI data, the likelihood of a Fed rate cut in March and May has been lowered. Specifically, the data showed US CPI annual rate rebounded more than expected. December unadjusted CPI annual rate recorded 3.4%. A new high since September 2023. US unadjusted CPI annualized rate for December recorded 0.3%. A new high since September 2023. Core inflation. US unadjusted core CPI recorded an annualized rate of 3.9% in December. A new low since May 2021. Slightly higher than market expectations of 4%. Monthly rate recorded 0.3%. In line with expectations. The report shows that housing inflation's contribution to CPI rise remains more than half. Energy prices rose. Electricity and gasoline prices both rose. This may explain the reading of the overall figure. Slightly higher than expected. Economists had previously expected gasoline costs to fall. Auto insurance and healthcare prices also rose. For a long time, had been expected that this would be a source of annual inflation. And used car prices rose for the second month in a row, breaking expectations of a decline, despite the pickup in inflation. But don't worry. Note that based on the following points. The first is worth noting. Rents make up a large portion of the CPI calculation. But in the PC data that will be released later this month. PC data to be released later this month. Which will be released later this month. Another piece of data from today. Attendance was lower than expected, which suggests the labor market is easing. The second thing worth noting is that the CPI data has limited impact on the federal PC is the Fed's preferred inflation indicator. December PC data will be released on January 26. Thirdly, as the inflation data is not overheating, hopes of a soft landing for the economy should not be affected. A pickup in inflation will not affect the overall tone of this year's cuts. In short, this data sets the stage for the Fed to cut rates this year. A moderate tone, progress in inflation, falling oil prices, and a resilient but loose labor market are all favorable to risky assets. This allows money to start buying on the downside. The stock market has rallied overwhelmingly. The current situation on the periphery is not really good. In the face of strong market expectations for a rate cut, ECB officials warned. Inflation is expected to continue to rise. Inflation will continue to rise at the beginning of the year. Interest rate cuts may not happen soon. The first of our camp's predictions for the times this year is that the process of achieving low inflation is fraught with uncertainty and vulnerability. Here, the brunt of the Red Sea crisis continues to fester, stirring up butterfly wings. Or to the global economy. Companies and consumers with economic and inflationary impacts. Maersk CEO said that the disruption of the Red Sea shipping lanes could last for months. Will disrupt global supply chains. Costs soar due to detours and rerouting. Global container freight index continues to rise. Maersk World's fuel costs have risen by 50%. At the same time, creating transportation delays and capacity shortages. In the short term, it could cause major disruptions in late January, February and early March, causing major disruptions. There are reports that the Houthis have reached an agreement with several international shipping companies. To signal the passage of merchant ships through the Red Sea. Through the Red Sea, as long as they send a signal, they can pass safely without being attacked. But Israeli shipping companies and Maersk ruled out. Let's go back to the market. The data shows that the market still expects the chances of a rate cut in March are still more than 50%. In contrast to the data, traders are now more dovish. This means one of them will end up being wrong. Which one it is will depend entirely on a series of key data. On a series of key data ahead of the March rate meeting. We don't think these numbers today are fast. But they do show that inflation is still slow to come down. These numbers are a reminder that bringing inflation down to the Fed's target level will take time, which will give the Fed reason to be cautious. We will focus on the labor market to judge the pace and extent of the rate-cutting cycle. We continue to believe that it would be more appropriate to start cutting rates at the end of the year. Here's one more thing. As we've said before, in addition to rate cuts, the market is starting to speculate about slowing down QT. That is, when the quantitative tightening will come to an end. Will it be synchronized with the first rate cut move? While market expectations for a March Fed rate cut continue to cool, but the trend of U.S. bonds is quite firm, including today's decline in U.S. bond yields. Part of the reason is that the recent focus is shifting to the topic of when the Fed will slow down. Tapering. March at the earliest in institutional forecasts. September at the earliest. There's a wide range of opinions. The Fed's taper has been going on for 18 months. With as much as $60 billion of U.S. debt maturing each month. And $35 billion in institutional debt maturing. As of today, the Fed's holdings of government debt has fallen to $7.2 trillion. The U.S. ringleaders are both showing. Some senior U.S. ringmaster officials have begun discussing when to start modifying the QT program. The big question is timing. To avoid a repeat of the turmoil of 5 years ago, the U.S. government must be careful. It's too early to talk about QT. MetLife Investment Management chief market strategist says. Relative to GDP, balance sheet still bloated. U.S. debt holders need to taper, so that if at some point there is another economic downturn, then quantitative easing can be restarted. Some analysts say financial system liquidity is the key. U.S. financial liquidity consists of three main components are U.S. debt holders holding securities or borrowing, Treasury cash accounts, and overnight reverse repos. And the liquidity of the U.S. financial system is ultimately presented as U.S. federal primary liabilities, minus TGA minus reverse repo, minus a few other signs. It's basically equal to bank reserves. So what's a reasonable level of reserves? About 8% to 11% of GDP. That's a pretty wide range. Will Northern Jiangsu's pace eventually stop at 8% or 11%? It's hard to predict. It depends very much. Depends a lot on the dynamic state of supply in the financial system. But analysts say that liquidity will be hit this year. That the U.S. government's surging interest bill on its debt will gradually drain bank reserves and liquidity. That's why peers expect the Fed to end QT. And the Fed's big brother Logan's statement seems to be the first step to end QT. Let's look at individual stocks. According to the U.S. Securities and Exchange Commission, Wednesday's filing, Boxer went on a buying spree last month, of Occidental Petroleum stock. In a series of trades, accumulated purchases of more than 15 million shares, at a total cost of about $900 million. Currently the stake has increased to 34%. Bank of America's 2024 Top 10 forecast sees as renewable energy stocks underperform, investors may be reawakening to the undervalued oil, gas and nuclear sectors, and thus shift to investing in traditional energy stocks. In addition to Warren Buffett's big acquisition Today a new U.S. natural gas player was born. Chesapeake merged with Southwestern Energy for a total of $7.4 billion. After the merger, will be the largest natural gas producer in the United States. In the midst of a new global energy transition. Since last year, major paint companies have been looking to merge to secure production scale. Last October, ExxonMobil threw $59.5 billion to acquire Pioneer Natural Resources, the paint industry's largest merger in 20 years. Chevron announced plans to buy oil producer Hess for $53 billion. To buy oil producer Hess. In December, Warren Buffett's Occidental Petroleum enters the shale oil fray. CronRock for $12 billion. The acquisition expanded Occidental's footprint in the prolific Permian Basin, covering more than 94,000 acres. This big buy by Polk Hill shows support for this approach. When all is said and done, Warren Buffett buying Occidental is considered a strategic allocation. We've talked about this before. But what's really made Warren Buffett a lot of money in the last 2 years is the Japanese stock market investment. Since last year, Warren Buffett has been increasing his position in Japanese assets. Japan's 5 largest trading company holdings is Berkshire Hathaway's largest investment outside the US. These 5 companies are Itochu listed, Mitsubishi, Mitsui & Company, and Sushio. These are the pillars of Japan. These are the pillars of Japan's economy and monopolize the country's necessities. This company's governance reform and Warren Buffett's influence. The Nikkei 25 index rose 30% in a year. It's a 34-year high, and before that, the Japanese stock market had spent more than 30 years in the dark. But this year, the Japanese stock market will hit a snag, which is the end of the Bank of Japan's negative interest rate policy. In 2024, the spread between Japan and the US is expected to narrow. This will be a test for the Japanese stock market. The good news is, the Bank of Japan is pressured by slower-than-expected wage growth. And analysts believe the earthquake that struck northwestern Japan early last year, which caused heavy casualties and economic damage, also makes it unlikely that the BOJ will adjust monetary policy anytime soon. To adjust monetary policy. Although this reasoning is a bit strange, but it's also the conclusion that the AI has. The conclusion. But the fact is, Japanese stocks are still not overvalued. Looking ahead to 2024, corporate profits are improving. Japan's regulatory reforms to the governance of listed companies are also boosting confidence in Japanese stocks. The JGB will hold its first monetary policy meeting of the year on January 22nd to 23rd, hold its first monetary policy meeting this year. The market expects Japan will stay put at this meeting. And finally, the big news in the market today is SEC's official approval of the Bitcoin spot ETF. However, ACC Chairman Gensler is still mixed in his words and actions, saying that it has not been approved. The approval of the Bitcoin spot ETF is recognized will bring more regulation. The market is also showing buying news. Short waves when selling the market. Many people seize the opportunity, thinking a suite of spot ETFs wasn't far behind, but Heisler gave a splash of cold water. He wrote importantly, today's ACC action is limited to Bitcoin, a non-security commodity ETF. That shouldn't indicate that the Commission is willing to approve listing standards for cryptoasset securities in the United States, regarding whether cryptocurrencies are categorized as securities or commodities. The debate has been going on for a long time. Securities and commodities. are regulated by different laws and different agencies. As far as I'm concerned, there may still be some problems with Ethereum that can't be treated exactly like a Bitcoin product. Okay, that's it for this video. The producer price index will be released tomorrow. And earnings season kicks off. Bank earnings reports. They're often seen as a great way to kick off the earnings season. And the economy. Last but not least, I wish you all the best of luck in your trading.